Let's talk about the markets then in 3 minutes. And I want to start with the level of risk aversion we're seeing through the Asia session. I guess this is yesterday's story when you look at those scale of losses on Wall Street and in Europe, more than 2% on some of these major markets. But there's been chatter in Hong Kong about maybe tweaking some of the quarantine rules. That doesn't seem to be lifting stocks all that much. What do you think it is that's weighing on the Asia sentiment? Is it all around Chinese growth?
What's interesting is there's not just one single driver. There's just this pervading negativity out there. I think probably the biggest issue for markets at the moment is the European energy crisis, and that still feels underpriced in European assets, particularly European stocks. But that is one kind of market that's dragged down, and that is, of course, the European economy is one of the kind of three big pillars of the world economy. So that's a really big issue. Then the US, people are specifically worried about the event risk of Jackson Hole. It's a little bit more nuanced story in the medium term. As you know, I'm very firmly in the kind of bearish camp for stocks over the next 6 months, over the next year, but I don't have a particularly, worry about the next week. But I think because of Jackson Hole, people are trading that medium-term negativity more aggressively. And then, of course, when you come to China, not only has the data just been terrible, and I think that's not the surprising bit, it's the fact that the PBOC and the government, all their measures have failed to stimulate any sort of rebound. And I say this as someone who is in the camp of expecting quite negative Chinese growth this year, but I thought that assets would be propped up by the policy moves, and that has just not happened.
Thinking about Europe and what you call the underpricing of the energy risks, why do you focus then on stocks then, Mark? I was listening at the end of the last hour, listening to our colleague Manus talk about how the Nomura view is that maybe this is underpriced even in FX, where we do see the euro below parity. It dropped back down below that to get today. 0.9921 is where we trade. But you think actually there's more room to move on stocks?
So I'm very bearish euro still. I still think euro has much more downside, and I have a lot of sympathy in the Nomura view. And look, I'm a macro guy, which means I tend to think of bonds and FX before I kind of go to stock markets as my default. But I think from here, it's the risk-reward idea. The euro has a lot more downside, but there are going to be really big squeezes. We know that the market is generally very long dollars. They are short euros. It's a consensus kind of view. And also the yield story here is more complicated because what we're facing is a major inflation crisis. And yes, it's a supply side inflation problem, so policymakers don't want to hike rates too aggressively, but they still need to stop that inflation feeding into inflation expectations and changing the game. So ultimately we're going to have squeezes where yields suddenly go higher. That makes the euro move more complicated, where it's just unambiguously bad for European stocks over the next 6 months.
OK, and you're pretty gloomy about stocks more generally. I was reading your macro view, very depressing as it was. I mean, for anybody longer stocks, it might be a depressing read, Mark. But I wanted to mention that the Stanford University economics professor John Taylor says there's still time to nip inflation in the bud, his words, and to avoid a recession. You very much don't see it that way.
So he said, as far as I remember, correct me if I'm wrong, Anna, that we need to get rates to 5%, which, remember, is about 100 basis points above what we're pricing in the market. That's already scared the market. So I think if we get his policy action, we'll get a real big collapse in stocks anyway. And I do think it will cause probably a recession, but maybe a softer one if we're active proactively.